Is an ISA or a SIPP the best way to boost your retirement savings? In this video, we pit them against each other and decide which is best for your retirement. Hi, I'm Marcus De Silva. I've been in the investment industry for nearly 15 years, teaching DIY investors simple strategies that help them invest sensibly for a better future. There are lots of podcast conversations and tutorials on the Steps to Investing YouTube channel. Check them out and don't forget to subscribe and turn on notifications for all of the latest. Many of us treat retirement savings as the elephant in the room. Research by financial advisor platform Unbiased has shown that almost half of us have no idea what size pot we're aiming for, with 1 in 3 unable to put a figure on how much income they would like in retirement. This is somewhat baffling. Retirement is arguably the most important financial goal in our lives. Industry trade body, the Pensions and Lifetime Savings Association, has attempted to frame the retirement picture a little and reckons to be comfortable, a couple will need a net income of £54,500 per year, with a single person needing £37,300 per year. To achieve this, you will probably have to cobble together a bunch of pension pots. There is the state pension, which if you have 35 years of national insurance contributions in the 24-25 tax year, would entitle you to around £11,500 a year. If you're employed, there's your workplace pension. And then there might be some old pensions from previous employers. But are all of these sufficient for all those rounds of golf and long-haul trips? Many will feel they fall short. Fortunately, there are ways to boost your savings using accounts which the government has furnished with special tax privileges. The first is the ISA, the second is the self-invested personal pension, or SIPP. Both have benefits and drawbacks when using them for retirement savings. So we know what that means. Let's put them in the ring, strap up those gloves, and go 5 rounds to decide which is best.
Round 1, taxes on investing.
Both ISAs and SIPPs completely shield you from any taxes when investing, whether it's capital gains tax, CGT, or taxes on interest and dividends received. This is important because it keeps more of your contributions in your pot, growing and compounding over time. This offers us an opportunity to save generously for our retirements. Remember, you're allowed to contribute up to £20,000 per tax year into your ISA and £60,000 or 100% of earnings, whichever is lower, across your pensions. That said, there is a difference in taxation on the way out. When it comes to withdrawing the cash, ISAs continue to remain tax-free, whereas for your SIPP, only 25% of the pot is tax-free. The remaining 75% is potentially liable for income tax, depending on how much income you earn in a tax year. ISAs get in a sneaky jab and win round 1.
Round 2, tax relief.
Wasting no time, SIPPs make an immediate comeback in this round as they are eligible for tax relief, whereas ISAs are not. It means with SIPPs, for every £80 you put in, the government tops it up with an extra £20 in tax relief. If you are a higher or additional rate taxpayer, then you can claim even more relief in your tax return. It means £100 invested could cost as little as £55. With the government giving you a leg up, even though there may be tax liabilities on the way out, it is hard to overstate the impact this boost has on your overall savings, especially when it's compounded over many years. It means SIPPs win round 2.
Round 3, easy access.
The problem for some people with pension savings is the thought of locking money away when they have a stack of financial responsibilities on their plate which may need responding to. SIPPs you can't touch before the age of 55, rising to 57 in 2028. But it's important to remember that once you do start drawing on the 75% that's taxable, you trigger something called the Money Purchase Annual Allowance, which means any contributions into your SIPP over £10,000 will no longer attract tax relief from that point. ISAs can be accessed whenever you wish, making them a good place to save if you need to get your hands on some cash. It means when it comes down to access, ISAs win round 3.
Round 4, investments.
When it comes to investing, both accounts are designed to give you plenty of freedom over what you invest in. This covers the spectrum from very risky individual assets such as shares and bonds, through to more diversified products, including trackers, funds, and investment trusts, across a wide variety of mainstream and alternative asset classes. If you're looking for ideas, there will be plenty of information at your investing platform, or else speak to a financial advisor. At the end of round 4, it's the draw.
Round 5, inheritance tax.
Our final round looks at the tax treatment each account faces once you shift off this mortal coil, and there's a difference between ISAs and SIPPs. For ISAs, if you're passing wealth onto your spouse or civil partner, then there's no inheritance tax to pay, and their annual ISA allowance will temporarily increase by the size of the inherited ISA for that tax year, meaning they can continue to save the cash tax-free within their own ISA wrapper. However, if you are passing wealth onto anyone other than your spouse or civil partner, then ISAs lose their tax status and form part of your taxable estate, which may face inheritance tax if your assets exceed £325,000 or up to £500,000 if this includes your primary residence. SIPPs, on the other hand, can be passed to any nominee free of inheritance tax, paid either as a lump sum or over time via drawdown. And there's another little quirk. If you're over 75 when you die, payments may be liable for income tax. But if you're under 75, there's no taxes to pay whatsoever. SIPPs land the final blow and take the final round. The scores are in and the judges have made a decision. It's a points draw. As is often the case with investing, fingers in different pies can be a good idea. SIPPs will slap your hand away from trying to dip into your nest egg early and keep you on track for that dream retirement. And let's not forget, the tax relief is a formidable force powering your long-term returns. But still, ISAs come with tax protections and plenty of investment options, and give you the flexibility to respond to any emerging financial challenges. For more in our retirement campaign, please subscribe to the Steps to Investing YouTube channel. Remember, when investing, your capital is at risk and you may not get back the original amount that you put in.